let's talk about tax, and let's talk about Section 1010, the foreign employment exemption. This is becoming more and more relevant because more and more people are working abroad, and they are working for 6 months abroad, or 3 months abroad. They may be going across for 2 years or 3 years on secondment. The world is becoming much smaller, and you remain a South African tax resident. And this Section 1010 used to be a bit of a safe haven, that if you were employed by any employer, South African employer, a foreign employer, and you worked specific periods overseas, then you had blanket exemption. It was just absolute blanket exemption. And then he changed it so that it's a maximum of 1.25 million rand per year. And that is for years of assessment commencing on or after 1 March 2020. So it's from the 2021 tax year for individuals, for natural persons. So this has created a bit of a dilemma for us, because in the past you could simply say that you just work it out and you said, oh, I've got exemption, it's totally exempt. But now you've got to have just the amount over the 1.25 million rand is taxable in full, but the first 1.25 million rand is not taxable. So it's becoming a much more complex section, and therefore I thought it would be worth our while to just spend an hour and just go through it in a bit more detail. All right. So what are we going to talk? We're going to, as usual, it's back to the law. You have to start with the law itself, and let's analyze the law. And then let's look at what SARS has to say about the law. And they have issued Interpretation Note 16, which we will go through with examples. Then we look at the interaction between your Section 1010 exemption and how your Section 6 quad rebates will work. And then we'll have a final look at the way that exchange rates implicates the taxability of the income, as well as the way what exchange rate you should use as you are claiming your Section 6 quad rebates. All right, so let's start with the law. Now, this is just the background to Section 1010. As I've said, is that in the past, you had blanket exemption. And the interpretation note just expands a little bit about what was happening. And what they were saying is that initially, the intention of Section 1010 was to make sure that you don't have double taxation. And that if you work abroad for a foreign employer, then you will not be taxed in South Africa, provided that you meet the 183 days and the 60 days limits. And that was in 2000. So life was good up to March 2020. So for a good 20 years, life was good. And because you simply had exemption if you had foreign employment income. But now what they said is that there was a bit of tax arbitrage, especially if you're employed in a country where there's a low tax rate. And then you pay almost no tax. And they do not want that. As a South African resident, they believe you should be paying tax on your worldwide income. And then they'll give you a little bit of a credit, which is the 1.25 million rand. And the balance, you need to pay tax on the South African in South Africa, and you can get a credit for the foreign taxes. So unless you formally cease to be a South African tax resident, you'll pay tax on it. There's no exemption on the excess over the 1.25 million rand. And again, the 1.25 million rand has remained constant since 2020. And as we all know, the rand has weakened so much that in dollar terms, that is about 2/3 of what it should be. All right. So let's look at what the section says. There shall be exempt from normal tax. Now remember, as we go through this, the term normal tax, you have to, income tax consists of 2 terms, normal tax and capital gains tax. So you will be exempt from normal tax, any form of remuneration, all right? So then they expand a little bit on the remuneration. So it's remuneration. To the extent to which that remuneration does not exceed 1.25 million rand. So that's the way that it brings in, to the extent that it does not exceed 1.25 million rand. In respect of what? In respect of a year of assessment. So you get the 1.25 million rand for every year of assessment. Your year of assessment for natural person, 1 March until 28 February. All right, so that's the year of assessment. In that year of assessment, you get the 1.25 million rand. All right. And it's received by or accrues to any employee. So any employee. So that means if you are employed by a South African employer, and you are asked to work in Namibia, you can qualify. Or if you are employed by a Namibian employer and you're working in Namibia, it doesn't matter whether or not you are employed by a South African resident or not a South African resident. Now, whilst we're at this topic, proposed legislation, currently, it's only South African residents that need to register as employer and deduct PAYE. It's only when you have a representative employer in South Africa that a non-resident employer will need to register as an employer in South Africa. Now, this legislation is bound to change, but they've buggered it up a bit. Because what they did is they just excluded the term any a South African resident. So it now means that any employer who employs somebody that is liable for tax in South Africa needs to register as employer in South Africa. Now, the intention is obviously that if you've got a German employer and you are working in South Africa for a German employer, that the German employer then needs to register for tax in South Africa. Sorry, not for tax, for PAYE. As an employer, deduct PAYE because you're working in South Africa. But the way that they've buggered it up, the impact of that is that, remember now, if you're a South African resident and you physically get on the plane and you fly to Germany and you work there for a German employer for 2 years and you earn 5 million rand per year, what will happen, the first 1.25 million rand per year will be exempt. The excess over that will be subject to South African taxes. It will also be subject to German taxes. You'll get a credit for the German taxes. And then you may, if the German taxes is lower than South African taxes, you pay in. The German taxes is more than the South African taxes, you'll get a rebate. But you're still liable for South African taxes. But how they bugger this up, this means that the German employer, even if you are not in South Africa, will need to come and register as an employer in South Africa. And that is how it was sloppy work. The way in which they drafted the draft legislation is absolutely sloppy, because it should just be limited to situations where people are employed by non-residents in South Africa. Then the non-resident need to register as an employer in South Africa. The way it's currently worded means that that German employer, even if they've got nothing in South Africa and you are physically in Germany, will have to register as employer in South Africa and do PAYE, and then ask probably for a directive that they can take into account the German taxes. So that will adversely impact the secondment arrangements for South African to work abroad, because it will just become untenable for foreign employers to employ South Africans. So we are hoping, and that's why I've not brought it into the slides, we're hoping that sanity will prevail and that the final tax legislation, as it will come out, will limit the application to situations where non-resident employers are employing people physically in South Africa. Then they need to register as employer for services rendered physically in South Africa. That makes sense. Doesn't make sense that a non-resident employer must register for employment taxes in South Africa for services physically rendered outside South Africa, irrespective of who that person is. All right. It was also intended that, for example, if the German employer then employs people in South Africa, Germans come to South Africa, that they'll also have to deduct PAYE of that. So that's the intention, but the intention is that the employees must actually work in South Africa, and the employer will deduct the PAYE of that amount. Anyway, so that's on a side note. This section 1010 talks about the exemption of part of your income if you are a resident. So it only applies to a tax resident, South African tax resident who's in employment. All right, so what does it apply to? It applies to if you are employed by any employer, you must be a South African resident, but you can be employed, as I said, by a Namibian employer or South African employer, doesn't matter. During any year of assessment, by way of what? Salary, leave pay, wage, overtime pay, bonus, gratuity, commission, fee, emoluments, or allowances, including fringe benefits, including your share option schemes or the vesting of options or shares in that is subject to certain restrictions. So Section 8C gains. All right. So it applies very wide, but it doesn't apply, for example, if you are self-employed. So if you're self-employed and you work for yourself and you work on contract basis and you don't work for an employer, and you get on the plane and you fly to to Namibia and you work on a contract basis for a Namibian company for 6 months or for 8 months, and you come back again, if you've got a big project there, then this section 1010 doesn't apply because you don't have an employment agreement with the Namibian company. So the mere fact that you work abroad doesn't mean that your income is exempt. It's only employment income that is exempt. So there is nothing to protect you if you are if you work on a contract basis and you fly over to Namibia and maybe you build a house in Namibia. You may be subject to permanent establishment there, and then you've got to look at the DTA with Namibia to see whether or not you enjoy any protection for South African taxes or for Namibian taxes. All right. In respect of what? In respect of services rendered outside the Republic. So there must be a link between the services rendered outside the Republic by that employee for on behalf of any employer. That's where any employer comes in, South African, non-South African, it doesn't matter. Now, this now comes to the period. If that employee was outside the Republic for a period or periods exceeding 183 full days in aggregate during any period of 12 months, we're going to elaborate on that bit. The paragraph B was the COVID relief because people couldn't actually be outside South Africa. So they just shortened the period. And for a continuous period exceeding 60 full days during that period of 12 months. So let's ignore the B, the COVID relief period, because it's just a reduced period. And let's just go through the general rules. And those services were rendered during that period of periods. So it sounds easy, 183 days, and they look at calendar days, and then 60 continuous periods. Okay, it sounds easy, but as you'll see, it's not that easy. All right. Provided that, and then there's certain provisos. The proviso is because the 183 days and 60 days, you can easily fall in or outside it. 60 days is 2 months. 183 is 6 months. And you can easily miss it by a day either way. So if you, for example, fly from Windhoek to Mauritius and you just stop at OR Tambo and go on, then you ignore the stop in OR Tambo. So that doesn't count as a South African day. The section 1010 also doesn't apply essentially for government employees. And then this is quite important. C, for the purpose of this subparagraph, where remuneration is received by recruits to any employee during any year of assessment, in respect of services rendered by that employee in more than 1 year of assessment, the remuneration is deemed to have accrued evenly over the period that those services were rendered. So that would apply, for example, on a bonus. So let's assume you receive a bonus in March of 2023 in respect of your services rendered for the last 2 years. Then that bonus is apportioned over the period. They say, thank you very much. Well done. Here's a bonus of $1 million. It is for services rendered over the last 2 or 3 years or the last 12 months. Then you've got to apportion it on a straight line basis to see where it belongs. Even though your section 7B will just mean that it gets taxed in the current year, it is relevant with regards to calculating your 1010 because your 1010 is calculated in the year that you bring it into your income. But you can actually double it up. So if you get a bonus in March of 2023 for the last 2 years of work, all right, and you were outside South Africa for that whole period, then you can get 1.25 million rand for the first period and 1.25 million rand for the second period. Obviously, if you've not used it already, but it means that you can actually double it up, but you only claim it in March 2023. All right, there'll be an example a bit later, which is quite interesting. So you can see it can actually become quite complex. Let's go and look at interpretation note 16. It's actually a very good interpretation note. It's got good examples. It's quite a lengthy one, so I've taken the most relevant pieces out of it. Okay, so let's just go and see what they say in interpretation note. What is it, 16? All right. Not all remuneration qualifies for exemption under section 10.102. The remuneration that qualifies is your salary, leave pay, wage, overtime, bonus, gratuity, commission, fee, emoluments, allowances for services rendered. Again, your leave pay could also be that one that accrues over a period, and then you can also double up your claim for that. Okay, and your fringe benefits and your section 8C. The exemption relates to remuneration received or accrued for services that were rendered outside the Republic during the qualifying period. Okay, that is correct. Periods outside the Republic where no remuneration was earned fall outside the ambit of section 10.102. So if you go to the US and you work for 3 months, and then you tour the country for 2 months, and then you work for 3 months again, that 2 months is ignored. Okay, so you must be actually working. It must be for services rendered. All right. So you may think, oh, I've been in the US for the last 2 years, but maybe you've been working for 6 different employers. Then you've got to ignore the periods that you've been just traveling the country. All right. Remuneration received subsequent to qualifying period, but in respect of such qualifying period, will qualify for the exemption, but subject to the applicable proportion. That is critically important. So again, you receive accumulated leave pay. There's accumulated leave pay. You've accumulated leave pay over the past 5 years. Part of that period in that leave pay, you were abroad and you qualified for 10.1.0 exemption. So you can claim the 10.1.0 now in respect of that period. And it could actually be 1.25 times 1.25. And even better, before 1 March 2020, there's no limitation of the 1.25 million rand. And there's an example on that on a section 8C. So if you receive leave pay for the periods that you work and you've accumulated the leave from 2018 to 2023, and you were abroad for 2018 and 2019, then you can get that period will be totally exempt because there's no limitation on that period of 1.25 million rand. So you pay out of the leave, you should look at what period did that leave accrue, take it into account and say, do I qualify for 10.1.0? And you can qualify for multiple 10.1.0s over the period. Before 1 March 2020, unlimited 10.1.0, and then after 1 March 2020, 1.25 million rand per year. It can actually work out good to your benefit on leave pay and bonuses. And then even your things like retrenchment pays. I've actually got something. So retrenchment pay could potentially qualify with salary, leave pay, bonus, overtime, gratuity, commission fee, emolument, or allowance for services rendered. I'll get to SARS, got a little bit of a different view there. Let's just talk about retrenchment pay just now. All right. Remuneration earned during the qualifying period in respect of services that were rendered both inside and outside the Republic must be apportioned. All right. Now, this is where SARS now becomes sticky, because you look at the principle of it, and then they say the exemption under section 10.1.0 only applies if employment relationship exists. That's fine. The services that are rendered for and on behalf of the employer must be rendered under an employment contract. That's fine. The term any employer means that services rendered to resident or non-resident employers qualify. Yes, we've talked about that one. An employee under common law excludes the independent contractor or self-employed person. Now, that's quite important. So if you are a non-executive director and you serve as a non-executive director on foreign boards and your source of income is foreign, you do not get the 10.1.0 exemption because you're not an employee or a non-executive director, you're an independent contractor. All right. Doesn't it qualify for self-employed? You've got to look through the DTA whether you enjoy any other benefit. Now, here's quite important. Directors, in their capacity as directors, are holders of an office, not employees. And to the extent that they earn directors' fees, such fees do not qualify for exemption under section 10.1.02. I do not agree with that statement. Because now, obviously, directors earn income as a director's fee. That's for attending meetings. And I'm not talking non-executive directors. I'm talking about just a fee as a director. And then the director could have a fee for a normal salary for working. So how do you split it? But this is the view of SARS. I don't necessarily agree with it. But if you are in that position, if you are a director of a company and you're a director of a foreign company, you earn a salary of a foreign company and you earn a director's fee, then in terms of 10.1.0, in terms of SARS interpretation of 10.1.0, you do not get it because you're not an employee, you're not earning the income by virtue of the capacity as an employee, and by virtue of your capacity as a holder of an office. Now, I don't agree with that because the definition of employee is anybody that receives remuneration. And your director's fee clearly is a remuneration, and therefore you are an employee. Again, if you're in that position, do a bit more research. And probably if you're taking a position that is contrary to an interpretation note, then protect yourself with a proper section 223 opinion where somebody can go and look at it quite in in detail and give you an opinion as to whether or not this exemption would apply. Now, many of the directors will already utilize 1.25 million rand, but as I said previously, you can earn income now in respect of periods before 1 March 2020 where there's no limitation. And a share option is the same. Now you get a share option. You are a director of a company. You get the share option. Now, does it apply? Does it not apply? Did you get it by virtue of your directorship or being a holder of an office, or did you get it by virtue of being an employee? All right. So you write the narrative, but if you're going to take a position on this, be careful about it. All right. Now, here is where SARS also take the view. Any remuneration must be received in respect of services rendered. Amounts payable by an employer to an employee, but which do not relate to services rendered, are not included in the scope of the exemption. And here they give some examples. Payments for the relinquishment, termination, loss, repudiation, cancellation, or variation of any office or employment, or of any appointment to an office or employment, are received by virtue of such termination, loss, repudiation, cancellation, or variation not in respect of services rendered, and accordingly not exempt. Now, let's get back to your retrenchment pay. In terms of South African law, you will get 1 week for every completed year service as a retrenchment pay. Clearly, there's a link between the services rendered and your termination payment. I believe you should get the 1010 exemption for it. But SARS will say, no, it's not because of your rendered services. It's because you are terminating your employment. So again, as you can see, SARS likes to take just a one-sided view on these things. This is not law. This is just SARS interpretation of law. This is the interpretation note. It's not law. This is not in the law itself. You can take an opposing view, but if you do take an opposing view, then please note that SARS will challenge you, and you've got to take a defendable view on this. I really don't agree with it, because if I pay somebody to join me, all right, so I'll say to you, okay, please come to and work for my company in Zambia, all right? Come work for my company in Zambia. I will give you a sign-on bonus of 500,000 rand, provided that you work for me for 2 years. That is clearly in a link to the employment to be rendered for the next 2 years. It's just almost like an advance income. It's a sign-on bonus. Now, SARS may go and say, but that's not in respect of services rendered. That is in respect of the appointment of you as a person. But the logic will tell to you, but hang on, sign-on bonus. It's for services rendered. So look at this one and see what SARS's view is on this. And I think part of the reason we're having this tax chat as well is to warn you to not just assume that the logic will prevail. Law is not always logical, and the SARS interpretation of the law is not always logical. They will interpret it the way that will be beneficial for them. All right. Now, so as you go through 1010, you go through the different things. Do you qualify? Are you a resident? Do you work for any employer? Then you look at the type of income. Then you put it into the buckets. Does this bucket of income comply? There's a fringe benefit. There's anything. The fringe benefits is quite interesting, because now let's assume you go to Zambia, you get a company car there. All right. Do you tax it according to South African legislation, or do you tax it according to Zambian legislation? Because I mean, it's a company car. South African tax legislation on company cars is very onerous. It's 3.5% per month, or 3.25% per month. And then you can reduce it with business travel. But now you go there, accommodation, all of those kind of things. It becomes very, very complex. All right. So let's get to the days. But before you go overseas, please check with a tax advisor, locally and foreign, to just make sure this is my package, and anticipate coming back and having to do a tax return every year. Because the mere fact that you're going to go overseas for 3 years doesn't mean you're not going to be required to submit a South African tax return. You are. All right. So the first day's test, period or periods exceeding 183 full days in aggregate. All right. So they talk about the full days. Let's not go into that one. But you look at calendar days. Now, this is relevant. You look at calendar days must be looked at, and not only work days, when calculating whether or not you're complying for the 183 days. All right. And you include weekends, public holidays, annual leave days, sick leaves, all of this. You include that. All right. Now, a distinction must be made between a situation where a person is in employment and is actually outside the Republic, but is not physically rendering services, and a situation where a person is physically present outside the Republic, but is not in employment. 1010 links it to the employment. I agree with that. Days spent outside the Republic when the person is not in employment do not qualify as days outside the Republic under Section 10102, and are thus not taking into account in the determination for the 183 days for purpose of the exemption. So you will go to America and you say, I've got a 4-month contract, and then I'll take 3 months leave. And you say, oh, I'm outside the country for continuous period, well, for more than 183 days. I'm there for 7 months, and more than 4 months is continuous 60 days. You think you qualify for 1010 because you only came back to South Africa after 7 months, but your employment was only 4 months. So therefore, you do not qualify for the 183 days because your employment was less than 183 days. Such broken periods of employment may arise if an employee is employed at intervals, right? Or, so you may be for 4 months, take a break for 3 months, and then work another 4 months. But if you look forward now for the 12 months, and you say, but you've worked for 4 months, and then 3 months off, so that's 7 months, another 4 months, that gives me 11 months. So in the year, you were more than 183 days. So you've met the 183 days. All right. An employee may, for example, be employed on a contract basis and enter into separate employment contracts for each broken period of employment. So you've got to look at that. The time in between the contracts where the employee is unemployed and where no services are rendered do not qualify for 1010. All right. Conversely, employees who remain in employment whilst outside the Republic but only render services for specified periods and then have rest periods will be able to claim the rest period as days outside the Republic for purpose of this day's test. So, for example, if you work 2 weeks on, 2 weeks off, 2 weeks on, 2 weeks off, that 2 weeks off will still qualify. Okay. So also, obviously, your annual leave and all of this. So be careful about that. So you look at that. That's the 183 days. So the first is the 183 days. And when do you start looking? It's any period of 12 months. So the day that you get on the plane here, you look forward and you say, for the next 12 months, did I meet the 183 days? And you can continuously looking forward, like every single day, you look forward for 12 months, you look forward to 12 months. But then you can also look back. You can, at any point in time, you stand there and you say, for the next 12 months, were I outside South Africa for 183 days for employment, or were I outside South Africa for 183 days? You look at any 12 months on a rolling period. So at any given point in time, you look forward, you look back, you look forward, you look back, you look forward, you look back. The moment that you qualify, looking forward or looking back, then you're okay. You are within the 183 days for the 1010 one. But then now what you've determined, I'm looking now, today is the 24th of October. So I look back from the 25th of October 2022 to 24 October 2023. Were I outside South Africa for 183 days? If I was, I qualify for 1010. Then I'll also look at, were I in that period continuously outside South Africa rendering services for 60 days? It's yes, then I qualify both 183 and the 60 days. And then I also, if I say no, I wasn't, then I can look today and I look forward for the next 12 months. So I can say, okay, from today's date until the 23rd of October 2024, am I outside South Africa for more than 183 days, and do I meet the 60-day one? And then if I do, then I qualify for 1010. Can you see now? That's why I only do tax return later on, because you can actually sit in a situation now and say, I don't know. Looking forward, I don't know. But when you do a tax return, and I come and do my February tax return, maybe in October next year, I will know. Because then in this period, I may qualify for the 1.25 million rand, to the extent that even in this year, I may only have been outside the country for maybe 2 months. But because it is then over the whole period, I will still qualify for it. All right. I don't know why they made it so difficult. That's just the way that it is. So SARS confirms this looking forward. They say a useful point to commence the inquiry would be by looking from the first day of the month in which a remuneration from foreign services was rendered, and then looking forward for 12 months. All right. And then you look at the 183 and the 60 days. And then if it's not met, then you look backwards as well. This is not an either or approach. Person is entitled to look forwards and backwards over any period of 12 months, meaning that some periods may overlap. The first month, if the first month in the test does not meet the requirement of the 183 full days and 60 continuous full days, the following month can be looked at, forward and backwards. Forward. So you can look at October, then November, December, literally on a day-to-day basis. The multiple use of any specified period is permitted due to the wording of the section that permits the test to be conducted over any period of 12 months. All right. So if you're overseas for any extended period, just take any point in time, look forward, look back, look forward, look back, forward, look back. All right, before you do your tax calculation. All right, this is a simple example. X was seconded by a South African holding company to a subsidiary in Australia for the period 1 March 2019 to 30 September 2019. So how does the look forward look back? On 1 March 2019, you look forward for the next 12 months to 28 February 2020. In that period, you were away for more than 183 days because you were away for 7 months. And in that period, that same period, you have been away for 60 days continuous, so you qualify. Okay. You can also look back. So from 30 September 2019, you can look back for the period 1 October 2018 to 30 December 2019 and say, during this period, so let's assume the employment started on the 1st of February 2019. Then the 1.25 million exemption 1010, so that's now obviously before the 1.25 million rand exemption came in. So then it would be totally exempt. The 1010 exemption will then apply to that 1 month income for February. So if it was from the 1st of February to the 31st of August, also 7 months, then you would apply for the exemption in that 1 month, and you'll apply for the exemption in the next month. Because when you look forward from the 1st of February for the next 12 months to the 31st of January, you qualified. And when you look backwards from 31st of August backwards, you also qualify. But it's either or. Once you qualify, you qualify. And you start off with the first day that you leave, looking forward. But you can look at this from 1st of March, and you can look at 1st of April, 1st of May, you can go on like you do. It's a constant rolling total. All right. Now, from 1 March 2020, foreign employment income is no longer fully exempt under Section 10102. The exemption is limited to 1.25 million rand in respect of each year of assessment during which the requirements of Section 10102 are met. The qualifying criteria are the same, so it's just the limitation that came in. Any foreign employment income over and above 1.25 million rand will be taxed in the Republic, applying the normal tax rate for the particular year of assessment. That's quite important. A DTA situation may arise. So double tax situation may arise in respect of the portion of the remuneration earned over the 1.25 million rand. Okay. So, and then this will happen where there's no tax treaty, or where tax treaty does not provide a sole taxing right to one country, which means that both countries will have a right to tax income, and the country of residence, in our case, the Republic, will provide double tax relief. All right, so when you're looking at the DTA, there are certain things that does not give you taxing rights. To say, you may not tax interest received if you are the person who pays it. Only the recipient company of the interest may tax it. Or it may just say, you may tax it, and it doesn't say you may not tax it. So if both countries does have taxing rights, and for employment income, the vast majority of the DTA give both countries the taxing rights, which means that if you are seconded to Germany, you can pay tax in Germany and you can pay tax in South Africa. But because the source of the income is in Germany, you can get a 6-quart rebate, so not a deduction. If you get taxed in Germany on services rendered physically in South Africa, then you can still get a Section 6 quart, but not a rebate, a deduction. So you only get a tax deduction, meaning your taxable income reduces because your source of income is in South Africa. Then you pay less tax, but you can only get effectively a tax deduction for it. If it's a rebate, you get bang for your buck for the full amount, obviously not more than the South African taxes that's attributed to it. Okay. So the credit may be claimed on assessment when an individual submits an income tax return, provided certain requirements are met. This effectively means that the foreign tax paid on the portion of remuneration, including in income, will be set off against the South African normal tax so that no double tax is suffered. That sounds very nice. Now, currently, if you're employed by a South African entity and they said to you, please go to and work for 12 months on a project in Namibia, then you qualify for this. Okay. The employer may then go and get a directive from SARS to say that, please, can we take into account, I'm not going to deduct PAY in the full amount because then the person's not going to have any money. Let's agree on either not deducting anything because it's a high tax jurisdiction or deducting a lower amount. So you can take the 6 quad credit into account when you apply for that directive. The directive, once you've got the directive doesn't mean that your tax position changes. It just means that your PAY is reduced. Okay. Now, if the proposed legislation comes through, it means that the foreign employer will have to register in South Africa, get a directive in South Africa to say that, hang on, let's deduct tax at the reduced amount, but still issue an IRP5 or IT3 to say that you have earned income from an employer. It's going to be a big commotion. All right. So there's just a little bit of a mind map. I'm not going to go through that in any detail. You can read through it at your leisure. Okay. So a common misconception is that all remuneration received or accrued during the qualifying period of 12 months is exempt. Now, you see how we do our calculations? This is incorrect. Only the remuneration received or accrued in respect of services rendered outside the Republic during the qualifying period of 12 months is exempt. All right. Remuneration received or accrued during the qualifying period in respect of services rendered in the Republic remain subject to South African tax. So even though you qualify for 1010, if you come back to South Africa, so you work for a South African employer, you are going to Namibia for the next 12 months, but every 3 weeks you come back here and you work physically in South Africa for 3 days. That 3 days in South Africa do not qualify for the 1010 exemption because it's work physically rendered in South Africa. All right. Now, remember, when you look at the 183 and the 60 days, we look at calendar days. Now, that period, now that you say, okay, I do qualify, but now to work out what component of your remuneration relates to services rendered outside South Africa and rendered in South Africa, you've now got to look at work days. So now you don't look at calendar days, you look at work days. So you can see how difficult it becomes. The 183 and the 60 days, you look at calendar days. But now, once you earn the income, my previous example, you're going to Namibia for a project there for the next 12 months, but you come back maybe 1 week every 6 weeks. And in South Africa, to now what portion qualify for 1010, you've got to go and work days again. All right, so let's look at an example. Z is employed by the South African subsidiary of a multinational company. Due to specialized knowledge, Z was requested to assist a New Zealand subsidiary and will be leaving the Republic on 1 May 2020 to commence work on 2 May 2020. Okay, so he leaves 1 May 2020, 183 days, 60 days, look forward. So if from 1 May 2020 to the 30th of April 2021, you meet the 183 and 60 days, then you qualify for 1010. All right. Z was contracted to work in New Zealand until 19 December 2020. The subsidiary company in New Zealand will be remunerating Z during the period, and Z will be departing New Zealand on 20 December 2020 to return to the Republic. Okay, so from 1 May 2020 to 30 April, you look at that period, and in that period, they are physically outside South Africa, calendar days, for up to about 1920 December. All right. For purposes of this example, it is assumed that Z will be, now this is important, will be returning to the Republic to fulfill local employment obligations during the following period, which will include travel days, 22 June, 30 August, and 11 November. All right. Now, this is the way that you now have got to do it. So the number of calendar days, you start off with the calendar days. The number of calendar days for which remuneration will be derived for services rendered in New Zealand in the 2021 year of assessment will be as follows. So you look at it, 2 May to 21 May to June, then 7 July to 29 August. So you only take the periods physically in New Zealand. So there is initially a 51-day period. Then they come back to South Africa for a few days, and then there's a 54-day period. Come back to South Africa for a few days, and then, thank goodness, there's a 64 days. If during that period they come back to South Africa, they wouldn't qualify for any of the 1010. Because as you can see there, through that line there, you add it all up now. 51, 54, 64, 29. So you've got two requirements. So from 2 May until 30 April 2021, clearly the 183 days was exceeded. That's 198 days. The second one is the continuous period. The first stinge that you had overseas was only 51 days. Doesn't qualify. Then you came back, and again, 54 days. Oh, doesn't qualify. Okay. Came back, 64 days. You've met it by 4 days. So now you've got to meet both. So now you do qualify. So the total remuneration that Z will be receiving for the services rendered during the period to May to 19 December is 1.5 million rand. Okay. As the table above indicates, the taxpayer will satisfy the requirements of the 183 days and 60 days, because you've got 198 days, which exceeds the 183 days, and that period, 8 September to 10 November, they exceed the 60 days. The taxpayer will have 2 easily identifiable periods from 2 May 2020 to 1 May 2021, and 20 December 2019 to 19 December 2020. Okay. That is then a look back period. All right. Now you're not finished. So now you say, okay, yes, I fall within 10.10. But now you've got to calculate what portion of the 1.5 million rand that you earned will then qualify. Now for that, you've got to look at your work days. So in the period from 2 May to 19 December, there was 161 full work days, of which 136 days were physically worked in New Zealand and 25 days actually in South Africa. All right. So you can't apply the full 1.5 million rand to the exemption. Now I've got to say, hang on, what portion of this 1.5 million rand applies? So it's 1.5 million multiplied by 136 over 161. So it's the work days outside South Africa in that period divided by the total work days. So that gives me 1267081. So 1.5 million times 136 divided by 161 gives me 1267081. So of my 1.5 million rand that I got in that period, 1250 applies, and it's in the same tax year, no? Because it's from May to December. All right. But my exemption is maximum 1.25 million rand. So what means is of the 1.5 million rand, 250,000 rand will be subject to tax in South Africa. You're not finished yet. All right. Of the 1.5 million rand remuneration, Z will be earning during the New Zealand assignment 1267 related services rendered in New Zealand during 2021. So 1.25 million rand of this will be exempt. Now, of the balance of 250,000 rand, 17,000 rand relate to services rendered in New Zealand, 232,000 rand relate to services rendered in South Africa. Now, on the component 17081, you can get a section 6 quad credit, okay, a rebate, because the services were physically rendered in New Zealand. Of the 232,919, you do not get the credit because the services were physically rendered in South Africa. Now, because the services were physically rendered in South Africa, then arguably you can get, if New Zealand tax authorities taxed that 232,000 rand, then you can get a deduction, not a rebate. And we'll be talking about section 6 quad in a future tax chat as well, because it's also very complex legislation. You can see, so now you've now calculated it. You got 1.5 million rand from the New Zealand subsidiary, all right? But of that amount, 1.25 million rand is exempt. The balance of 250, a part of it relates to services outside, a part of it relates to services inside. Then the bit that is rendered outside, you get a 6 quad credit. The bit that's rendered inside, you get the 6 quad deduction. SARS actually says here, you will not get no relief in the form of a tax credit will be applicable against this portion of the income. They fail to say that you will get a deduction against it, which you would. All right, now I get to an interesting one, and that is section 8C. Okay, so if you get a share and the share is subject to any restrictions, or you get an option and is subject to any restrictions, then you tax yourself on the vesting date. Now, even though the tax incident work on the vesting date, the underlying services may be over a period. So, for example, you can get a share for 5 rand, but you're not allowed to sell the share, meaning that is a restricted equity instrument. So on the day that you get the share for 5 rand, you're not allowed to sell it, okay? Then there is no tax incident at that date. You must keep it for 3 or 5 years. After 3 or 5 years, you are entitled to sell it. The moment it becomes an unrestricted equity instrument, the tax incidents happen. So let's assume we buy it for 5 rand, and after 5 years, when you're entitled to sell it, the market value is now 85 rand. So you've made an unrealized gain of 80. Whether you sell it or not, you have an HC gain of 80. All right. So obviously, what people need to do is, and it's very unique internationally, they try to match the tax on it when you actually sell it. Our tax authority is saying, the moment it becomes saleable, you must pay me my tax. Right? The fact that you don't sell it is irrelevant to me. Thereafter, if you keep it, then you pay capital gains tax on it. You'll be okay. All right. So now, in this example, is the HC gain arose over 5 years. And as I said, in terms of the section, it says you are deemed to accrue that gain equally during that period. So there's no arbitrage in the way in which you apportion it. Now, again, that is calculated based on work days. So the gain is taxable, but then you work it out and you have to use work days, not calendar days, work days. It's quite a comprehensive example. Let's go through this comprehensive example. All right. Now, on 1 July 2015, now this is relevant because remember, my 1010 had no limit. 1.25 million rand had no limit until February 2020. All right. So 1 July 2015, an employee of a South African holding company acquired 45,000 shares at 5 rand each from the South African company by virtue of employment. Under the agreement, DG is not permitted to dispose of the shares until 1 July 2020. The shares were granted solely to retain DG services. So 1 July 2015, you get the share for 5 rand. You're not allowed to dispose it, so it's a restricted equity instrument. On 1 July 2020, which is 5 years later, you're allowed to sell it. The HC gain then arises on 1 July 2020, and you must pay tax on 1 July 2020, PAYE, everything on 1 July 2020 in your February 2021 tax returns. All right. Meaning that, in this example, they assume that the market value then increased to 85 rand. So at that period, you've got 45,000 shares. You've got 45,000 shares. You bought it for 5 rand. At the date that it became unrestricted, the market value is 85 rand. So you've got an HC gain of 80 times 45,000 shares, which is 3.6 million rand. So in the normal situations, 1 July 2020, 3.6 million rand comes to you in taxable income. You pay tax on it, and that's just the end of the story. All right. But now, DG rendered services. Now you've got to look back over that 5-year period. You say, hang on, but I'm not getting a 3.6 million rand income. Is there a portion of that that I can say is exempt in terms of 1010? So look at this. DG rendered service to a Nigerian subsidiary from the period 1 April 2017 to 31 March 2020. So that's a long period. They met the 183 days and 60-day continuous days for this entire period, and thus any remuneration earned for services rendered outside the Republic during that period qualifies for under Section 1010. Now, 1 April to 2017 to 31 March to 2020. Now, from 1 April 2017 to 28 February 2020, no limitations, no 1.25 limitations. From the 1 month March 2020 period, there was the 1.25 million rand. But what they're saying is that in March 2020, he received a bonus of 900,000 and a salary of 400,000. So that bonus and salary of 900,000 rand that already exceeds my 1.25 million rand. Now, they've overcomplicated it with this bonus because they did not look back on that one, but let's just assume that then in that March period, they've already exceeded the 1.25 million rand limited. All right. DG also rendered services outside the Republic during the lock-in period, but outside any qualifying period from 1 October 2015 to 30 October 2015. That's just 1 month. All right, so on 1 July 2020, when DG becomes entitled to dispose of the share, they will vest under Section 8C, and the market value is 85 rand, so you've got 3.6 million rand. All right, look at this calculation. So now, you receive 3.6 million rand. Now it's deemed, undoubtedly the 3.6 million rand accrues to you in your 2021 tax year on 1 July 2020, undoubtedly, okay? But now you've got to see on whether or not you qualify for your Section 1010 exemption. And now you've got to look back. And you're going to have multiple year entitlements for the 1010 for all the periods that you qualify. All right. So let's just look back. So it's deemed, the 3.6 million rand is deemed to accrue straight line basis. All right. So the total work days from 1 July 2015, when it was granted, to 1 July 2020, when it was exercised, is 1,252 days.
Now you allocate it to every tax year. So 1 July 2015 to your 2016 year, to 28 February 2016, 28 February 2017, 28 February 2018, 19, 20, 21. There's 169 days, 250 days, 250 days, 250 days, 83 days. Right. Now you've got to apportion it based on that. So you take the 3.6 million rand and then you apportion it. You say, okay, based on that 169 divided by 1252 and the like, that 3.6 million rand. And remember, only for purposes of 1010. 485,000 rand is deemed to accrue in the 2016 year. 718,000 rand is deemed to accrue in 2017 year. 718,000 rand in 2018, the same for 2019, the same for 2020, and 238,000 rand for the 2021 year. Right. Now, so you look back, and then you say, okay, now, if in the 2016 year I've received 485,000 rand, did I in any period qualify for 1010? The answer is no, because you were not in that stage. I think it's in Nigeria. Yes. So because you only went to Nigeria from 1 April 2017. So the whole 2016 year you were in South Africa, so no 1010 exemption. In the 2017 period, also no exemption. But now in the 2018 year, because you went to Nigeria on the 1st of April 2017, all right? So you were outside the Republic for 228 days. So there were 250 working days in the 2018 tax year. Of that period, 228 was outside. So you take your exemption is then 228 divided by 250 multiplied by 718. Exempt in terms of 1010. And no limitation of 1.25 because that period is before the 1 March 2020 date. And you do the same. So in your 2019 year, you say, I was in Nigeria for the full 250 days. So the full 718,000 is then subject to the 1010 exemption. There's no limitation. So the full amount is exempt. And you do the same thing for 2020. And now in 2021, you do the same. Out of the 83 working days to which this option relates, 22 was in South Africa. So 22 over 83 is 238,000 rand. But I've already used up my 1.25 million because I've got a bonus of 900 and I had a salary of 400. So I've already used it up. So the full amount is taxable because the limitation kicks in. The example is wrong because the bonus of 900,000 rand, you've also got to start looking back again. And then, so the example is wrong. But you can see the principle of it. So what happens now? You get the 3.6 million rand in 1 July 2020 in your 2021 tax year. You will claim a section 1010 exemption of 2 million rand and you tax yourself on the balance. All right. All right. So the first bullet there, that is for the 2021 year. Since DG's remuneration for foreign services will exceed 1.25 million rand in March, the full amount of 63,000 rand will be taxable, which is then the 22 over 83 times the 238,000 rand. Okay. And the bottom line is the total taxable gain for HC in the 2021 year is 1.5 million rand, which is the 3.6 minus the 2 million rand. Please spend some time and go through this because once you get clients that've got HC gains, they've got bonuses, they've been outside, inside, all those kind of things, it becomes very, very complex. All right. Now, to make it even a bit more complex, let's look at section 6 quat. And the example 7 is given in the interpretation note 18 now. So interpretation note 18 deals with section 6 quats. So individual A, age 30, rendered services inside in South Africa during the 2022 year of assessment. Remuneration for services rendered inside South Africa amounted to 500,000 rand. Remuneration of 1.5 million rand was received for services rendered outside South Africa. Right. So you earned 2 million rand. You qualified for the exemption of 1.25 million rand under section 1010, and the foreign taxes of 450,000 rand were withheld from the remuneration of 1.5 million rand. Okay. So in the year, you got 2 million rand, of which 1.5 million rand was outside, 500,000 rand was inside. Of the 1.5 million rand, foreign taxes of 450,000 rand was withheld. So let's do the tax. So the income from a South African source is 500,000 rand. No problem with that because I worked in South Africa. It's for 500,000 rand. The taxable income from a foreign source is 1.5 million rand. I qualify for 1010. So my maximum 1010 exemption is 1.25 million rand. So I pay tax on the 250,000 rand. So my taxable income in South Africa is 750,000 Rand. So now you work out your tax on this taxable income. So it is 216,531. All right. Now you've got to say, but hang on, I get a credit now. So you've got two-step approach to do that credit. Because remember, you've now included the 250,000 Rand, but you've paid tax on the 250,000 Rand. But you paid tax of 450 on 1.5. So now you've got to work out how much tax did you actually pay on the 250. So the formula that SARS uses is you take your taxable foreign income over the total income. So it's 250 over 1.5 multiplied by the 450. So the formula assumes that you pay the same rate of tax from Rand number one that you earn, which is clearly incorrect because most countries have got, in South Africa, I mean, you don't pay any tax on the first 70,000 or 80,000 Rand. And then you pay tax until about 1.8 million, you hit 45%. So this methodology will say, okay, work out your average rate, and that applies from Rand 1, which is not really right. That's the formula that they apply. So 250 over 1.5 multiplied by 450 gives you 75,000 Rand. So what they're saying is the taxes, the foreign taxes that you've paid on the 250,000 Rand. So remember there's 250,000 Rand in there. The South African taxes that you've paid on the 250,000 Rand is 75,000 Rand. You're not finished. You can't just claim 75,000 Rand. Now you've got to say, but hang on, this 75,000 Rand is limited. My rebate is limited to the taxable income that I pay on that. So then you take the taxable income derived from foreign sources over my total taxable income multiplied by my South African taxes. So the 250, which is the 250 of the foreign, over the 750 times the 216,531, which is my final tax there. Then I say on that 250,000, my South African tax is 72,177. I've now worked out that I've actually paid foreign taxes of 75,000 Rand. So my rebate is limited to 72,177. All right. All right. So under section 6.1a, foreign taxes qualifying for rebate are limited to the foreign taxes in respect of foreign income included in the residence taxable income. Foreign taxes in respect of the exempting the foreign income of 1.25 million Rand therefore do not qualify for the rebate and are not carried forward to subsequent years of assessment. So of the 450, you only get bang for your buck for the 75,000 Rand, the rest you're forfeiting. The 72,100 of the qualifying withholding tax is deductible, and the balance of 2,823 is carried forward to the following year. All right. And then we're going to close out in the last 2 minutes with an interesting one, and that's the exchange rates. Because now, remember, you've now got to do South African tax return. You are earning dollars, you're earning euros, you're earning whatever. So how should you tax it? Then you've got to go and look at section 25D. 25D1 says to you that you have to use the spot rate on the date on which that amount was so received or accrued or expenditure or loss was incurred. That's the general rule. So whenever you earn, when the remuneration accrues on a monthly basis, you use the spot rate on a monthly basis. But a natural person or a non-trading trust may elect that all amounts received by or accrued to or expenditure or loss incurred by that person or trust in any currency other than the currency of the Republic be translated to the currency of the Republic by applying the average exchange rate for the relevant year of assessment. All right. So average exchange rate is being published by SARS. You can just go and look at what it is. It's a defined term. So if you're a natural person and you get foreign income, you can either use the spot rate every month that it accrues to you, or you can use the average rate of exchange at the end of that year. Now, SARS publish it there, and you can see on the left-hand column, if, for example, you are February 2023, you can accumulate all the euros and convert it to 17.4329. Or you can go and look at the spot rates, and if you get a better answer, you can use that. All right. So you can choose, but once you've chosen, you must use it consistently for that year. So this is just an example of an individual. He earns interest income in USD, rental income of British pounds, and dividend income in Kenyan shilling. So when you calculate it, if you choose to use the average rate of exchange, you've got to use it for all sources of income. You can't say, I'm going to use the spot rate for the interest, and I'm going to use the average exchange rate for the rental income. You've got to choose one, use it consistently. But you can use it for the 1 year, And the next year, you can then use the spot. And the next year, you can use the average rate again. So there's room, especially with the rand going up and down as it is, there's room for some arbitrage for us. So if your client is earning foreign income and non-ZAR denominated income, then there's some room for arbitrage within that, playing around with the average exchange rate versus the spot rates. All right, so be careful or be noted of that. Only natural persons and non-trading trust. Your credit must, however, be converted at the average exchange rate for that year. So when you work out your foreign exchange credit, then you take your foreign exchange credit and you don't convert it as spot rate every time that you withhold it. You accumulate it all, and then you get to the average exchange rate at the end of the year. And in that case, if it is in UK pounds in February 2023, you must take 20.25. You don't have a choice. Okay. So if it's different, if it's USD, you must take 16.7116. You don't have a choice. So for your foreign tax credits, you're obligated to use that. And that was exactly an hour. Thank you for joining us. We will be looking at your provisional taxes and your underestimation penalties and the like on the 21st of November 2023. Then we'll take a little bit of a break in December. We won't have a tax chat in December. And then we'll carry on again in January. I hope you're enjoying our tax chats. Well, thank you so much for joining us. We would truly appreciate your support, and I hope you find value out of it. Please, if you want copies of the webinar or certificates of attendance, just email Michaela at our office, and she will sort you out very, very quickly between her and Emil. Thank you for everything. I hope you have a wonderful day, and hopefully we can be the world champions in both rugby and cricket. Goodbye.